听听资本本期视频为您带来的是摩根士丹利在3月27日录制的有关关税政策对新兴市场影响的话题内容。新兴市场固定收益资产最近有点像坐过山车，大家都在盯着下周4月1日和2日的关税公告，这可不是小事。尤其是汽车关税刚公布，对墨西哥这样的国家来说简直是当头一棒。如果美国对所有进口汽车加征 25% 关税，墨西哥经济可能直接滑向衰退，连带着新兴市场资产价格都得抖3抖。别忘了还有互助关税在后面等着，可能会让贸易成本再涨一波。亚洲和欧洲的国家尤其得小心，地缘政治这边也不消停。乌克兰和俄罗斯的战争还没停，中东的以色列局势紧绷，委内瑞拉和巴拿马的动荡也让市场捏把汗，这些乱局直接推高了资产价格的风险溢价，投资者稍不留神就可能踩雷。美国国内的情况也好不到哪儿去，经济增长放缓，通胀粘性不退，这些都在给新兴市场泼冷水。下周的数据要是再不给力，市场情绪可能会更糟。新兴市场里有些国家最近也麻烦不断，土耳其的外汇上周贬了 3.5%， 债券收益率飙了600个基点，哥伦比亚和印度尼西亚的资产价格也在晃。不过好在这些目前还只是个别国家的麻烦，没酿成大乱子。可投资者别太乐观，市场对这些风险的消化还没完，稍微有点风吹草动就可能翻车。市场现在就像在等一颗重磅炸弹落地，关税公告一出，新兴市场货币估计得乱一阵，投资者已经在调仓位，想躲开这场不确定性的风暴。下周绝对是关键一周，公告的结果可能会直接决定市场是松口气还是彻底炸锅。接下来是英文会议的全部内容。如果您需要我的投研助理人工校对的中文文本，您可以在频道的 Patreon 上获取。
Hello, and welcome to our 10E8 Emerging Markets Focus podcast, a place for us to discuss recent developments and key issues of focus in the emerging market fixed income asset class. I'm Johnny Golden, Head of EM Fixed Income Strategy here at JP Morgan, and I'm joined by Saad Siddiqui, Head of EM Local Market Strategy at JP Morgan. Saad, thanks for joining.
Hi, good to be here.
So, EM and global markets seem to be stuck in a bit of a holding pattern for the last bit as we're really waiting for the next set of tariffs, which may or may not bring some clarity to the overall tariff environment, impact on EM, and some of the other broader themes that markets are very focused on. So today in the podcast, we'll discuss how we're looking at EM fixed income markets in the light of the upcoming important day that we will have next week, and also update on some of the EM country-specific risks that were so much in focus last week and part of our discussion.
So, Johnny, let's get straight into it. What's been going on in emerging markets as we await the next key event risk next week?
Yeah, so we've talked probably for much of the first bit of this year as well that there has been a bit of a holding period for markets from the inauguration in January till the start of April, and that was set in place because the major tariffs actually were not outlined quickly. Rather, there was an America First trade policy executive order signed early on, but that document gave a time frame which landed around the 1st of April for reporting on all the various issues around trade and tariffs. And for markets, that naturally gives you a period from one to the other while we know we're not going to have all of the answers yet. Clearly, there have also been a lot of developments while we're waiting, and all those channels that we talk about that US policy will hit EM fixed income have been pretty active since then. So we have had other tariffs announced, auto tariffs announced last night. We'll come on to those. There have been second developments under what we have been calling geopolitics, which encompasses Ukraine-Russia war, developments in Israel and the Middle East, Venezuela, Panama, all of which have actually been impacting asset prices in our world. And then finally, there have been the US domestic data, which has been telling us something about the state of the economy, and there were growth concerns, sticky inflation, maybe a bit less on the growth concerns at the moment. We have in the last week seen, as we are getting now closer to what has been moved to the April 2nd tariff date, there's a bit of, an unease in EM markets, which is sort of manifesting in not a lot of movement for EM asset prices. Spreads in the last week are a couple of basis points tighter. Rates are a few basis points higher. EMFX is a net small weaker against the dollar. And I think there is just an inherent uncertainty about what we're going to get next week and the impact of it. And certainly it feels like this eerie sort of quiet has descended a little bit on markets in the last week or so. I think our own views generally, as we've been outlining in these discussions, have been more on the cautious side for EM fixed income, given the lack of risk premia that we have been seeing, certainly in EM credit spreads, both sovereigns and corporates. And also, we've talked before about EM rates having relatively low pickup against US yields, given a backdrop also of the end of cutting cycles coming nearer in many countries and inflation is stagnating. So generally, the last few months you've seen spreads and yields edging higher, but this is really only quite slow, and certainly that can go more if we get more negative tariff announcements next week. EM currencies, we've generally outlined, we've seen it a bit less directionally as a block, given the cross currents, and been playing different regions as a way to position there. But that's sort of where we are at the moment, and the run up to what markets have probably been focusing on as an important week next week. So, Saad, let's get back into the question of tariffs. What are we focused on for next week in terms of announcements? What are the different components, reciprocal, sectoral, etc.? And particularly, obviously, for those in EM fixed income markets, what do we think is going to be the most relevant things to pay attention to?
Sure. So the 1st of April was formalized as a relevant date on the back of the America First trade policy document, which President Trump released shortly after inauguration. And in that report, in that document, it stipulated various reports and investigations to be conducted by the Commerce Secretary, by the Department of Treasury, and by the USTR. And those reports were to be delivered on the 1st of April. So the 1st of April has been on the radar for markets for some time already. And then more recently, the administration has been really emphasizing that date as a so-called Liberation Day, when they will announce a whole bunch of tariffs and other remedies that will be off the back of the investigations and reports that are due on the 1st of April. Now, some of the thunder of the 2nd of April date was stolen yesterday because you already had a pre-announcement of auto sector tariffs. We'll talk a little bit more about that. But broadly speaking, I would put the things we're interested in next week into two categories. One is the set of reports that we're going to get on 1st April. And those reports will be basically, I think, for market participants in two buckets. In a bucket of its own is this currency manipulator report, which I think is going to give a sense of how the administration views, pegged or managed exchange rate regimes, particularly in Asia. So that's one thing to watch out for. And number two, it's going to be a bunch of reports that outline various kind of non-tariff barriers to trade practices, and the like. So that's on the 1st of April. On the 2nd of April, there will be remedies proposed off the back of those reports. And really, there's two categories of tariffs we're thinking about there. So one is reciprocal tariffs, and the other is sector tariffs. Now, on sector tariffs, we've already had the auto sector tariffs announced last night. It's 25% tariff on all imports of finished autos coming into the U.S. And for now, it seems for Canadian and Mexican USMCA imports, only the non-US content will be subject to a tariff. And then there's some other arrangements for auto parts to determine what the USMCA content is of those. The other sector tariffs that I think markets were expecting previously, like pharmaceuticals or semiconductors, it seems like the administration has kicked them down the road. So not clear that we are going to get other sector tariffs next week. It feels like auto might be the only one that we get. And then reciprocal tariffs, if I take the sum total of all the commentary that's been coming out over the past few days, seems like there will be a lot of discretion as to how those are imposed. Now, recall that in its simplest version, a reciprocal tariff is the US will match the same tariff that the partner country charges, on a line item by line item basis. So you go through each category, and the US will simply match the tariff that the trade partner has in that category. But it seems like from the comments that we will have a lot of variation in that. It's not going to be so precise in that sense. There's the other question of whether VAT is going to be matched as well as part of reciprocal tariffs. And again, not obvious. So feels like on the reciprocal tariff side, we're going to get something that maybe on average looks like it's, the simple version of the reciprocal tariff, which we'd estimated previously would increase the weighted average US tariff on the rest of the world by about 5 points. But it seems like we're going to have a lot of variation on the reciprocal tariffs front.
And following up on that, which countries or regions in EM are likely to be in the spotlight for the tariff impacts? Obviously, we have different tariffs, but where's the focus going to be? Has there been a lot of risk premium priced in for this? And also, I guess we need to talk about the auto tariffs, which were announced last night. Where in EM are they likely to have a bigger impact?
So I think there are two game changers in terms of the parameterization of tariffs. And number one is on reciprocal tariffs, whether we get VAT being matched or not. And that'll impact a lot of countries. EU countries specifically would get hit very hard on that. So then you could have a tariff that ranges between 15 to 25%, up to 30% for some countries, because you have a lot of countries that have high VAT and complex VAT regimes. So that's one potential game changer. The other potential game changer is related to what we had last night. So if there's no further exemptions or carve-outs for USMCA auto imports, then I think that is quite a significant blow for the auto industry in Mexico and Canada. And, we already are looking at Mexican GDP growth slowing down very sharply, could potentially induce a recession as well off the back of it. So if we get this kind of full-on version of auto tariffs, I think for Mexico and Canada, it's very significant, especially for Mexico. And then the other markets where you're unlikely to see any meaningful carve-out or exemptions, it's mostly Korean and Japanese auto exports to the US as well as EU exports. So those are the major trade partners for the US in terms of auto trade. But the one where I think it really does matter is for Mexico. And I think the market so far has been hesitant and reluctant to trade tariff announcement at face value. We've already seen several times now that you get exemptions, you get delays, postponements. So there is a negotiation element involved, especially for auto tariffs on Mexico and Canada, because the supply chains are so deeply intertwined. It does impose a high cost in the US as well to impose these tariffs. So the market has not been trading these at face value, and clearly has an implicit belief that we will get some dilution of what's been announced over time.
So I guess a follow-up and maybe the last point to ask about on tariffs is, we started off we outlined there's a period, there's a date, the market is waiting for some reports and announcements next week. But as you've sort of highlighted, there is a decent chance that we don't have a conclusive outcome on tariffs next week, i.e., there are some things announced, there are other things which are withheld, which are said to be coming. There are potential carve-outs which are hinted at, maybe not imposed yet. And how do you think the market, and particularly thinking about EM currencies here, which we always felt would be really the first line to be impacted by tariffs, how do you think currencies are going to trade in a world where we just don't know everything next week? And do you think people are positioning much for this? Any metrics that we have which show about that, or discussions whether you think EM investors are trying to actively position for a scenario here?
Look, I think at the start of the year, the market was basically taking the view that tariffs are to a large degree a negotiation tool. We're not getting that much delivery. And the starting point is really important because recall at the end of last year, EM currencies were in deep oversold territory coming into the inauguration. Liquid currencies like Brazil had sold off quite a lot. So in a sense, the uncertainty was favorable for EM FX because the starting point, it was really cheap and oversold, and no news was good news at the time. That's how we were characterizing it. Obviously, a few months later, you don't have currencies looking as cheap. They're closer to fair value. Our EM FX risk appetite is in kind of modest negative territory, isn't giving a very strong signal here. But I think we are going to start seeing the cumulative impact of that uncertainty starting to play through. We've already seen it in terms of downgrading growth expectations in those markets directly subject to the uncertainty, like a Mexico, for example. And I think that could broaden out potentially. You also have the cross current of whether U.S. growth is slowing down sharply or not. We've discussed previously that U.S. growth does seem to be slowing down. There is a confidence souring taking place domestically, but recession risks are increasing from very low levels. So then we talk about where are we in that dollar smile? If we do have a sense that global growth is slowing down, there's a cumulative impact there. Then I think EM currencies as a starting point now versus 3 months ago don't have the same valuation buffer. So there's that element to it. My view is that the regional approach that you mentioned above is still probably the right way to think about it. The costs of trade policy and trade uncertainty are very concentrated in a small number of markets in Asia, in Mexico, whereas I think we still have some wood to chop before we get to a stage where we're genuinely concerned about a U.S. recession and kind of a safe haven bid for the dollar going up again. Now, against that backdrop, we had a lot of idiosyncratic events taking place in EM as well, over the past couple of weeks. Do you think those events now, Johnny, are still, really in the headlines, or do you think they're beginning to fade away a bit?
Yeah, so I would say in summary, things have calmed down. If we look at the major ones, Turkey obviously had a 3.5% FX depreciation last week. Maybe that's not the biggest indicator to move, but this week has been more stable. Local bond yields, which went up nearly 600 basis points last week, have actually come back a bit, about 125 basis points at the index level. Sovereign credit spreads went about 50 wider, but are back 20 basis points from their peak. So it's not been a continued source of volatility this week in the way that it was last week. It's unlikely the market is going to be able to forget or fully unprice that additional risk premium for the time being, but certainly it hasn't continued with that volatility this week. Israel has continued to see headlines this week centered on domestic political developments. FX has been weakening there against the dollar, but some of that is related really over the last month and a half to the fall in US tech stocks, which we've noted have been having a larger impact on the shekel recently. We've also highlighted the currency looks cheap. They passed their budget, and it could be that headline noise comes down a notch domestically, but it does look unlikely it's going to completely fade here as well. But probably hasn't been grabbing the headlines as much this week either. Some of the others, Colombia, Indonesia, calmer this week in terms of asset prices. They were big movers the week before. And when we look at some of those high yielders, which were also sources of volatility, Argentina, Egypt, Nigeria, markets try to extrapolate some of the weakness in the idiosyncratic into some of those areas. They've also been generally calm this week. There has, it looks like, been some de-risking which had happened by foreign investors in those countries, probably healthy, but they look a little bit more stable this week. So we talked last week about how these EM situations were very country specific. There have been some press articles which have tried to draw some connections between the uncertainties around US policy and how that leaves space for some of these domestic changes. But generally we have and still see these as idiosyncratic. It doesn't look like they're pointing to any EM systemic issues at the moment. For things that are going to drive broader EM markets, that probably is going to come back to the US policy and tariff discussions, and we will know more about that as we go through next week. And that brings us to the end of this JP Morgan at Any Rate Emerging Market Focus podcast. Thanks to you, Saad, for joining today. And thank you all for listening, and we hope to have you back again with us for the next one. This communication is provided for information purposes only. Please refer to JP Morgan research reports related to its content for more information, including important disclosures. 2025 JP Morgan Chase & Company, all rights reserved. This episode was recorded on the 27th of March, 2025.